Alright, what's up guys? Today's video is mistakes to avoid while day trading. Pretty much every trader in the beginning is going to make a lot of these mistakes, but hopefully watching this is going to help prevent that for a lot of you guys. So, first mistake I have, trading with real capital before having an edge. So, there's a common saying that 90 or 95% of day traders fail, and that's because they give up by the time they know what they're doing. So you don't want to be trading with real capital before you know what you're doing and before you know that you have an edge against the market. So some people might be good at playing bounce plays, some people might be good at breakouts and things like that. You want to know what you're good at before you start risking your money towards it. So paper trade until you prove to be consistently profitable over a long period of time. I usually recommend 1 to 2 months. If you can be consistently profitable over a 1 to 2 month time frame, you can start trading with real money. When you do start trading with real money, don't go in too heavy, just because you're most likely going to experience some emotions and stuff like that with the fluctuation of your capital. But after being profitable for a couple months, you should know generally what the right thing to do is and what the wrong thing to do is. You know, where your entries should be, stop losses, profit targets, things like that. And this is a marathon, not a race, so there's no reason to jump into it too quick if you don't know exactly what your edge is. So this is a quote, relates a lot to day trading. So it's, give me 6 hours to chop down a tree and I will spend the first 4 sharpening the axe. So pretty much you want to be working on your craft before you start going in with real money. You want to know the right things to do, the wrong things to do, mistakes to avoid, things to, risk more money towards versus just throwing money at pretty much any setup that comes to you. If you spend more time working on your craft than actually jumping into trades, you're going to know that, 1 trade a day is more than enough to be a very profitable trader. So another problem is not respecting your plan. So some people don't even have a plan going into the market. They'll just look around, they see, oh, this stock is up 5%, let me just buy calls here, not knowing anything about the levels, anything about where they're going to stop out. They're just pretty much chasing. So trading without a plan is gambling. I'm going from the bottom, I don't know why, but whatever. Trading without a plan is pretty much gambling, and that's not what we're planning on doing as day traders. You want to know that you have an edge, that there's a higher probability of your setup hitting. So that's pretty much, you can look at it as gambling, but it's really, you know what your edge is, you know how to manage your trade, manage your risk. So that's how you become profitable as a day trader. You have to stick to your stop losses or profit targets. So that all comes with having a plan. You want to know by the time you hit the buy button where you're going to stop out if the trade goes directly against you pretty much right away, and where you plan on taking profit targets if the trade does go your way. So for me, I like to scale out towards my profit targets. A lot of times I have multiple targets. I'll have like a first, I'll take off half here, take off another half, and then maybe leave runners to the last target, which might be a little bit longer of a trade, but since I'm in so light, I already locked in all my profits. If it does come back, I know where I'm going to get out of those runners, probably still green. Over the long run, this will help you build your edge against the market. So knowing where your stop loss is and your profit target, it's going to help you know like pretty much your edge, what you do best, and where you can execute the best. Early entries without proper confirmation, there's a reason you set your entry target. So when you're making your plan pre-market, you want to know, I want to get in, 10 cents, 20 cents before my level or something like that. And then if you're in $1 before your level could never come. So it could be a trade that you just should have never taken, because there's a reason you set your entry at that point and not $1 before. So early entry is increased risk just because your level could have never came, meaning there's no reason for you to ever take the trade. So, and then be confident in your plan and your trade, but also be willing to take a loss if it doesn't go your way. So pretty much nobody has a 100% success rate, and you can't let one loser take away from all your winners. So you do want to be confident in your plan, but you don't want to be overly confident to where you're never going to stop out, because that's how you're going to blow your account. You want to know that if this trade does go against you, that it was worth the risk, because you know your edge, and you know that if you keep taking those trades, let's say 6 out of 10, 7 out of 10, 8 out of 10 times, it's going to work for you, and it's going to pay for those losses. But if you let the loss go way past your stop loss, then you're totally going against your edge, your plan. You're pretty much on your way to blowing your account, just because you're not managing your risk properly. So another thing with not respecting your plan or not having a plan is you're risking capital on a trade that you didn't have planned for, that you might not have an edge on. You might just see some random intraday setup at some random level that means absolutely nothing, and you might go in with regular size. But trades like that, that's not your edge. If you know that your edge is on the 4-hour chart or the 1-hour chart at specific breakout levels, like that's usually what I do, then taking a random setup intraday on some random bull flag somewhere, it might work out, but you're going against your edge. You don't know that this setup 9 times out of 10 is going to be successful, because you could lose on it more than you win, and it's not worth the risk to take those trades. Another big problem is overtrading. This was a big problem I had in the beginning. I would take 5-10 trades in a day sometimes, thinking the more you trade, the more money you can make, when in reality it's the exact opposite. If you take 1 to 2 trades a day, then you know that you're sticking to the absolute best 1 to 2 trades in that day. Some days you might not even take a trade just because your setup didn't come. And overtrading is a sign of deviating from your plan. There could be days that you planned out 4 or 5 trades and they all happen, but usually if you take the best 1 to 2 in that plan, there's no need to take the other ones, because you could be giving back profits, you could be risking capital when there's really no reason to. And let's say you do have 4 or 5 trades planned out pre-market, 1 or 2 are going to look way better than the other ones. Like one stock is going to be stronger than another stock, one stock might be weaker than another stock, one might be moving better against the market, and things like that. So you don't want to give back profits. If you're up on your first trade, up a lot, up more than you're usually up, you executed it perfectly, there's a second trade coming and it looks okay, but I'm up on the day, I can just risk my profits pretty much for this trade. There's really no need for that when you're already up a lot, you executed right, you stuck to your plan. You don't want to give back profits. Like over the long run, if you keep risking your profits, it's not going to be better for you. And another big thing is don't revenge trade. If let's say you did stick to your plan, you took one trade, it was a good setup, futures looked right, momentum looked right into it, you got your entry and it immediately goes against you, don't revenge trade. There's no need to. If it's not a trade that you had in your plan, don't take the trade. Usually revenge trading is when you go from down $100 to down $300, down $500. Now you're not sticking to your stop losses on those revenge trades. It's not even something you had planned. You don't know why you got in. You're just chasing things, things like that. So this is a quote from someone in stock hours that stuck with me for a long time. There's always another trade. There's always another day. If you're looking here, walk away. Remember what happens when you don't. So this goes with stopping out on your first trade or first 2 trades or something like that. You stuck to your plan, you did all the right things, you stopped out where you're supposed to, but you're still looking around the market. You're looking for new setups, new trades. You're looking at every stock on your watch list, just trying to find some kind of setup, some wedge, some downtrend, trend line breaks. Like, you'll look for anything just to make those losses back. And 9 times out of 10, when you're looking around that hard for a setup, that's when you're going to take a trade. You're going to lose big. You're not going to stop out. Things like that. That's what you don't want to get into. If you come back tomorrow, the market's going to still be there. It's not going to care that you lost or you made money. The market's always going to be there. If you're down, you stuck to your plan, you did the right things. Don't deviate from the plan. Don't start doing the wrong things just because you want to make your money back. Another big problem with every type of trader is trading with emotion. So some emotions you might go through are hope, fear, greed, FOMO, kind of goes with fear, and impatience. So hope, you don't want to, pass your stop loss and be like, oh, I hope this comes back to break even so I can just get out, be flat on the day. If you set a stop loss, there's a reason you set it there. You don't want to go past that stop loss. Let's say you had a 10% intended stop loss. Now you're down 12%. You're like, all right, let me just wait for it to come back to 10%. And now it's down 15%, 20%. And you're like, all right, I just want it to be, back to 15%. And then it could just keep bleeding for the whole day. And you not respecting your stop loss is going to totally just bleed your account for no reason. There's a reason you set that stop loss. You just have to stick to it. Not every trade is going to go your way. So the trades that don't go your way, you want to, manage those stops, keep them tight. Fear, not letting your trade play out. Let's say you are in a green trade and you sell because you're up 2%. I mean, green is green, but if you're risking 10% to make 2%, and then you have a profit target, and then you see your profit target hit after you sell for 2%, when there's really no reason to have sold, then it's gonna make you want to get it back. Like, oh, I could have made this much in that trade if I stuck to my plan, if I did the right things. So yeah, taking profits too early. Greed, doubling down on losers. Never do that. It's the worst habit you can develop. If you're down 10%, you buy, you double down. Now you're technically down 5%, but you're doubling your risk. You're probably not going to stick to your stop loss. There's just so many things that can go wrong with that. FOMO, fear of missing out. If you miss an entry, it's fine. Like, there's going to be more trades. No need to chase. If you chase, your stop loss is going to have to be bigger, and then your profit targets are going to be smaller. So there's really no reason to chase. If you're ever feeling FOMO, literally close out that stock, open another stock. If that's the only stock you're watching, close out, your trading platform. Just go on with your day, enjoy your day. FOMO is never a good thing to trade with. And impatience, wait for your setup. If it doesn't come, don't take the trade. So this kind of goes with those early entries. Don't just get an early entry because you want to make more money or something like that. Wait for your setup, wait for your level, and then get in there. You're going to know how to manage it when it sets up right for you. If it never sets up, there's no reason really to take the trade. So trade the charts and your plan, not what you think the market should do. So if you think, oh, we're at high day, we push so much, let me buy puts here because the market has to come down. The market doesn't have to do anything. The market will do whatever it wants to do. It doesn't care what you think. You're probably trading with under $100 million, so the market doesn't really care anything about you. You make no difference to the market. Just trade what is in front of you, not what you think should happen. Trade like a robot. So pretty much, your stop losses and waiting for your setups. Like, don't hop into a trade because you think something, you want something. Just trade like a robot. You see a setup come at your level, take it, stop out where you need to stop out, take profits where you need to take profits. And big thing with emotion is not accepting your stop loss and letting those losers run. I was kind of talking about that before with hope. You can't just, oh, I'm not going to stop out at this level. It's going to come back to break even. Things like that. Like it's a terrible habit to build. Not learning from your mistakes, which basically means you're not journaling enough. You want to be journaling thoroughly enough to where you can tell everything that went wrong in the trade, even if it's a green trade, or everything that went right in the trade, even if it's a red trade. There's going to be something to learn from every single trade, even if it's, that you did the right thing and that you should keep doing this, or you could have got in here instead of here, or you should have stopped out at this level versus this level. You could have got out for break even, or things like that. You want to journal as thoroughly enough to where you can tell everything that went wrong and everything that went right, and then reflect on that to build a plan for the future, to not have those same mistakes go on, and to do more of the right thing in the future. Because when you're trading with more money, pretty much every mistake is going to be emphasized. If you're breaking your stop loss when you have $1,000 account, it might only be a $10 difference. But if you're on a $1 million account or $10 million account and you don't follow your stop losses, you're talking tens of thousands or even hundreds of thousands of dollars of you not respecting your plan. So if you can identify and fix your most common mistakes, you can prevent most of your losses. To an extent, however, there is still not every trade is just going to go your way. But if your common losses are chasing or not stopping out at the right time, then you can prevent a lot of those losses. If you can identify what you're best at, you can avoid taking trades that don't support your edge against the market. So you're not going to be, pretty much the same thing, you're not going to be chasing trades. You're going to wait for your setup and trade your setup when it comes. If it doesn't come, then you might not take a trade that day, and that's fine too. Improper risk to reward. This is more of like a, not a big problem, but I don't know how to explain it. Whatever. It's still a problem. You wanna work on this, but it's not like one of those things that, whatever. So as scalpers, we typically don't have the best risk to reward in our trades, which is why we have to respect our stop losses. Pretty much every type of trader has to respect their stop loss, but scalping specifically, since you're not looking for these huge moves, you're more looking for a quick in and out. If you're not stopping out right away and you're letting that stop loss take up all your profits from 2, 3, 4 trades, you're not going to be profitable. So you need to respect that stop loss. As a scalper, you want to look for at least 1-to-1. That's what I recommend. And then scalping is more of like, you want a higher success rate. So like, let's say you win 80% of your trades, but you're 1-to-1 risk reward, then that's fine. That's something you can do. Over a longer period of time, you will prove to be consistently profitable, but you have to have those stats first. Look for 1-to-1, and if you can squeeze more out of the trade, then it's a really good trade. So like those times where I'm sending 20%, 30% trades, that's not common. Like that's not usually what happens. If I have a 10% trade, that's a really good trade. So getting those bigger trades, I'm usually scaling out. I'm not in with my whole position. It's because I have multiple profit targets along the way. So I'll sell my position at each of those profit targets. If one doesn't hit and it pulls back, then I'll still sell for green. But if you're a day trader, someone who looks for bigger moves, you typically want a higher risk to reward because your success rate isn't as high as a scalper, who might be like 80%. A day trader might even be less than 50%, but they're making more on their wins than their losses, so they can lose a lot. Some day traders even look for like higher than 3-to-1, which it's good if you find a profitable system. But yeah, I think that is it. Yep, that's it. So I hope this helps someone. You have to reflect on your mistakes and fix them before you grow your account. or else your account won't grow. I've heard of people turn a $3,000 account to a $15,000 account with no principles, no rules, just pretty much luck. And then a couple weeks later, you hear about they blew everything. Like they lost their entire account because they didn't know how to stop out. They didn't know what their edge was. They kind of just took trades, hope it worked out. If it worked out, they cashed out. If not, they lose everything. So in the long term, that's not going to work. You need to know what your edge is, know what works for you, what doesn't work for you. But that's it, guys. Peace.